Business owners think that financial statements are just boring paperwork for taxes, but these reports are like an X-ray of your entire business. If you cannot read them properly, you are flying blind. Once you understand what all these numbers really mean, you'll never look at your business the same way again. You will never be caught off guard. I guarantee you. So today, I'm going to show you in very simple terms exactly how to decode your financials. And in the next video, we'll go much deeper into learning how to analyze your numbers so you can see what I see. By the way, I'm Alex. I've been in accounting and finance for over 15 years. I have top professional designations, and working with numbers is what I do every day. After years of looking at financial statements, my team and I learned to spot patterns that reveal way more than just profit and loss. They tell a story about the business owner too. Are they in control of their business, or is the business controlling them? By the end of this video, you'll know exactly what each statement shows, how they connect to each other, and why you need all three to really understand your business. All this assumes you have reliable, well-kept accounting records to even put these financial statements together. If your books are a mess, that's the very first problem I recommend taking care of. But assuming your records are decent, let's dive in. Let's say your business is like a house. There's money coming in, money going out, maybe a mortgage, maybe a car, groceries in the fridge, maybe still fresh, and that's your household economy. Imagine trying to manage that household without knowing how much money you actually have or where it goes, like trying to manage your house with the lights off. There are three financial statements that form the foundation of your financial house. Think of them like three windows, each giving you different perspective on what's going on inside. The income statement is more like your family income and expense summary. The balance sheet is your financial snapshot. It's like pausing a movie and seeing what's in the fridge, what's in the bank, and what you still owe on a house at this very moment. And the cash flow statement shows where the cash physically goes. Each window tells you only part of the story, but you need all three to really see what's going on inside. The accounting system tracks everything through a deceptively simple rule called double entry accounting. Every time something happens, every transaction, it always affects two places at once. It's never just one thing, and amounts don't just disappear into thin air or come from nowhere. Your financial house is like a sealed container. There are always two sides to every transaction. If accounting wasn't already exciting enough, accountants decided to spice things up. Instead of using words like increase and decrease, they came up with the terms debit and credit. Here's where people get confused. A debit doesn't always mean something went up, and a credit doesn't always mean something went down. A debit to cash means your bank balance increased, but a debit to your credit card means you paid it down. A credit to revenue means income went up, but a credit to cash means it went down. For now, just think of debit as left and credit as right. And no, it has nothing to do with the political spectrum. It's just how the system stays in balance. Every entry always affects both the left and the right sides equally, and it all adds up perfectly. Unless it doesn't. In which case, I recommend having a very serious conversation with your accountant about it. So keeping that in mind, let's summarize the three statements and what they show, and then we'll return to the household analogy to help you understand these statements better. Let's start with the only report most business owners ever look at, the income statement, if they look at anything at all. And by the way, if you know anybody who's like that, please share this video with them. There's way more to financials than just income. The income statement tells you the story of whether your business actually made a profit or just kept the lights on when everybody got paid, hopefully including you. It all begins with revenue, the top line. If you sell more than one product or offer multiple services, there is no requirement to break it down. You can be granular to help decision-making, but you don't have to be. And you can simply show all your revenue sources under one revenue line. Next is cost of sales, also known as COGS, cost of goods sold. These are not your regular expenses. These are direct costs tied to what you're actually selling. If you don't sell the product, you don't incur that cost. For example, if you run a candle company, your cost of wax is a direct cost. If the candle company sells fewer candles this year, they will need less wax. Revenue minus direct costs gives you gross profit, which shows you how much money you're actually making from the actual thing you sell, before everything else. Now we subtract operating expenses like rent, salaries, marketing, that software subscription you forgot to cancel 3 years ago, and so on. These expenses are still tied to running your core business, but they don't fluctuate based on sales volume as directly as COGS. If the candle company sells fewer candles this year, they would still need to rent and maintain the shop, keep advertising, and keep paying their employees. How many different expense categories you have is often a personal preference. For example, some business owners might track Google ads and Facebook ads as two distinct expense categories, others would keep them both in marketing. There are some rules, but in most cases it all depends on your decision making, not so much a regulatory requirement. After subtracting operating expenses, you get operating income, or EBIT. Earnings before interest and taxes. Interest and taxes are excluded from this metric because they are not part of running your core operations. They're still part of your business income statement, but they would go below the operating line. Speaking of exciting accounting acronyms, here's another one for you. That's earnings before interest, taxes, depreciation, and amortization, pronounced as EBITDA. After revenue and gross profit, EBITDA is one of the most widely used metrics in financial analysis. It tells you how your company is performing as an operation. Are you actually running a profitable engine or just burning gas? Now, let's break down the last part, the D and the A, depreciation and amortization. Technically, they're part of your operating expenses, but they're kind of not real. They are non-cash expenses. They represent your assets getting older. Let's say last year you bought a delivery truck and let's say it lost about a fifth of its value due to wear and tear. That's depreciation. A fifth of the truck kind of vanished into thin air, even though no money left your account. Amortization works the same way, except it's for intangible assets like patents. It's the same concept, just a different asset. EBITDA tries to get closer to cash performance of your business to reveal how the business is really running before other noise distorts the picture. But EBITDA still is not actual cash. And that's mostly because of accruals. Sounds like a skin condition, right? But no, that's not a disease, even though it does cause some pain. I'll explain. Let's say you sell 1,000 candles to Walmart on December 20th. They agree to pay in 2 weeks, so the payment will come next year. But because the sale technically happened in December and Walmart owes you the money, you still record that revenue in December. That's an accrual. You earned it, but you haven't touched the cash yet. And same goes for expenses like receiving a bill in December and you paying it next month. You still record the expense this year in December. So your EBITDA could look very healthy this year, even though you would have only $5 in your bank account. That's because of timing mismatches between commitments and cash. In some circumstances, you could make things simple and use cash-basis accounting, but the accrual method is the gold standard because it's more accurate, more comprehensive, and in most tax jurisdictions, it's preferred, if not required, especially once you hit a certain revenue level. Finally, once you subtract interest and taxes from your operating income, you land on net income. And that's the income statement's bottom line, the big reveal of your company's overall performance after all said and done. But we are not done yet. Net income flows into something called retained earnings, a key part of the balance sheet. And the balance sheet is where things get real. It's not about performance anymore, it's about your company's financial position. The balance sheet is a snapshot of your business at a single point in time. Unlike the income statement, which tracks performance over a period of time, the balance sheet shows the company's financial position right now, frozen in time. Think of it like pausing your favorite TV show. Everything stops. What you see is what you get at that exact moment. The balance sheet is divided into 3 main sections: assets, liabilities, and equity. Assets are everything your business owns that has value. If it can be converted into money or used to run the business, it belongs here. Assets can be tangible, the ones that you can touch, like cash, buildings, cars, inventory, computers, and intangible. something that has value but is less physical in nature. Think client lists, patents, goodwill, and so on. Liabilities are everything the business owes. This includes loans, unpaid bills, credit card balances, taxes payable, and so on. If it must be paid in the future, it goes in this section. Some liabilities can be both short-term and long-term. Think of a 30-year mortgage. It has a portion that you need to pay throughout the year and a portion that goes beyond just 1 year. Equity represents the owner's stake in the company. It includes any money you put into the business, plus all profits the business has earned over time that haven't been taken out. That's why it's called retained earnings, because it contains the earnings that have been retained. Retained earnings ties directly back to the net income from your income statement. Each year's profit or loss gets added to the accumulated total in retained earnings on the balance sheet. This turns the balance sheet into more than just an asset and a liability snapshot. It becomes a historical record of how your business has performed historically and where it is now. The balance sheet follows a simple formula: assets equals liabilities plus equity. Remember when we talked about debits and credits, left and right? This is where it starts to matter. To increase the left side of the equation, an asset, you would debit it. And to increase the right side, liabilities or equity, you would credit them. When it comes to the income statement, anything that increases your profitability or reduces your expenses goes on the credit, right side. And anything that decreases your profitability or increases your expenses goes on the debit, left side. The formula should always balance, and if it doesn't, either your bookkeeping has errors or your accounting system is not set up correctly. Generally, the higher the equity, the better off you are. It means that more of your business belongs to you. But positive equity doesn't always mean strong financial health. Businesses can have sizable equities compared to their liabilities, but also have serious cash flow issues. When a company does not have enough cash or assets that can be converted quickly into cash, accountants call it a liquidity problem. Oh, those accountants, right? For example, if the majority of your clients are delaying payments, your income statement might look strong, but your business might still be struggling to meet payroll next week. Let me know in the comments if you've ever experienced an unexpected cash crunch like this. Many business owners obsess over their income statement. The income statement is critical to understand, for sure, but the balance sheet can quietly reveal stress points that might be invisible on the income statement. But there's another statement that often overlooked. It's called cash flow statement. And because cash isn't just king, it's survival, let's look at it next. The cash flow statement answers three main questions: how much cash do I have, where did my cash come from, and where did it go? Cash flow statements are actually built from your income statement and the balance sheet. You can construct a cash flow statement just by looking at those two reports. Think of the cash flow statement like your car's fuel gauge, but not just how much gas you have left. The statement shows where the gas went: actually driving the car, running the car's air conditioning, or powering the electronics. The statement is divided into three parts: operating, investing, and financing activities. Operating activities start with your net income from the income statement, then it adds back non-cash items like depreciation and amortization. Then the section also adjusts for changes in how much your customers owe you and you owe suppliers, as well as changes in inventory and other short-term operating assets which are shown on the balance sheet. And the reason you do it here is because they're not reflected on your income statement, but it's still part of your operations. So if you increase your inventory, it would not be shown on your income statement, but you still want to show the impact on your cash flow statement. Investing activities show buying and selling big stuff like new equipment, buildings, or vehicles. And financing activities show cash in and out from lenders, owners, or investors. For example, getting loans, paying loans back, investors putting money in or taking money out, all go into that investing section. The cash flow statement breaks down which activities use your cash or provided cash. Because you can't pay bills with profit, you pay them with cash, it's important to understand the cash flow. And many business owners learn it the hard way. Cash flow, not just profits, determines whether you can keep the lights on. For smaller businesses, you might not even need a formal cash flow statement every month or at all. And in most jurisdictions, cash flow statement is not needed for tax filings either. But if you're doing a 3-statement forecast or report to investors or lenders or for strategic planning, the cash flow statement becomes critical, if not mandatory. Now let's bring all this knowledge back to the household analogy from the beginning. Let's assume your house is worth $1 million. That's your asset on the balance sheet. Now let's also say you have a mortgage for $700,000. That's your long-term debt. But you also need to make 12 monthly payments of $4,500, that's $54,000 this year, including interest and principal on that mortgage. The principal portion of those 12 payments, let's say $20,000 a year, becomes your short-term debt on the balance sheet because it's due within a year. The interest portion goes to your income statement as an expense. Your car is another asset. But so are your furniture, TV, fridge, and other appliances. And your phone bills, utilities, and groceries, those are your operating expenses on the income statement. But what if you decide to build a swimming pool in your backyard? Is that an expense or an asset? This is actually a great example of investing activity on the cash flow statement. Any addition that has long-term lasting value, like a swimming pool, is generally not an expense but a capital transaction. It goes to the balance sheet as an increase to the assets. And if you decide to get a loan from a bank to build that swimming pool, your liabilities would go up and your liability increase would show as a financing activity on your cash flow statement. When you pay down that loan each month, your cash decreases and your debt decreases as well, but your income statement will only change if you're paying interest on that loan. The interest is an expense and it will show on the income statement, but not the balance sheet. You see how all the statements constantly interact? Your income statement flows into your balance sheet through retained earnings, where every year's profit gets added. And your income statement also flows into the cash flow statement as the starting point for operating activities. Some balance sheet assets flow back to your income statement through things like equipment depreciation. And major purchases and financing activities change your balance sheet, which affects your cash position. And your cash position determines what you can actually do in your business. That's the financial reporting feedback loop in action. And speaking of feedback loops, please let me know if you like or didn't like this video. And please be honest, seriously, my goal is not just getting as many likes. I want these videos to keep getting better, and your feedback is extremely important. I recall a conversation with one of our very profitable clients last year. He was always concerned that they had no cash in the bank. Like so many business owners, they only looked at their income statement that showed consistent, healthy profits, and yet no cash. The client was concerned there were mistakes in their accounting records or even fraud, and the first glance at their balance sheet revealed the answer. We prepared a cash flow statement which clearly showed that while profits were in the hundreds of thousands, the client was actively repaying debt and upgrading their equipment. Their debt was decreasing rapidly and their assets were increasing. But because those changes are not reflected on the income statement, only on the balance sheet, the client missed two very large activities depleting their cash. Those activities did not make the company weaker. Paying off debt is almost never a bad idea, but it did make their company less liquid. Without understanding this connection, you might plan for growth that looks great on paper but leaves you broke in reality. So how do you actually analyze financial statements like this? In part 2 of these videos, we take a deeper dive into financial statement analysis, advanced metrics, and how to spot the red flags that can save your business from serious trouble. But for now, I suggest starting simple. Compare your cash on the balance sheet to your actual bank statements. All of your bank accounts should be reconciled and match exactly every month. Look at your income statement and balance sheet trends year over year. Do any patterns look unusual to you? And check if your accounts receivable are growing faster than your sales. That could mean either you're attracting slow-paying clients or your collection process is very inefficient. These are just the basics, and if you want to learn more, we also prepared a free guide to help you become a more savvy financial statement reader. The link is in the description. Also, let me know in the comments if there is any other topic you'd like me to cover. Thanks for watching, don't forget to subscribe, and see you in the part 2.